Welcome to The Explainer. Today, we're diving into an absolute giant, Benjamin Graham's The Intelligent Investor. Now, let's be clear, this isn't some get-rich-quick scheme. Think of it as a map, a battle-tested guide for getting through the wild, chaotic jungle of Wall Street, written by the legend who literally taught Warren Buffett how to invest.
First things first, we've got to understand the territory. The financial world today is, well, it's a noisy place. It's filled with hype, endless commentary, and so many promises of easy money. And you know what? A lot of that confusion is by design. It pushes us to gamble, to speculate, instead of actually investing.
This quote right here, this is the voice of a market bubble. It's from the absolute peak of the dot-com frenzy back in 2000. People were literally saying, it's a new era, the old rules don't apply anymore. And anytime you hear that kind of talk, you should know that danger is probably right around the corner. And what happened when people threw out those old rules? Well, this happened. A 76% collapse. That's the value that vanished from Cisco Systems, one of the darlings of the dot-com boom, in just 2 years. It's a brutal, painful reminder that chasing the hot new thing and ignoring fundamentals is a very, very expensive mistake. So if the modern market is a chaotic maze designed to get us lost, who can we possibly trust to guide us out? It's time to meet our guide, Benjamin Graham. He's not just some professor. He is the undisputed father of value investing.
I mean, just look at this guy's resume. He taught Warren Buffett. He had already seen a bubble burst with auto stocks way back in 1919. And he didn't just survive the 1929 crash and the Great Depression that followed. He figured out how to thrive in the wreckage. He then went on to average around 20% returns for decades. His wisdom wasn't theoretical. It was forged in fire.
All right, so the first thing Graham gives us is maybe his most powerful tool of all. It's a really simple distinction, but it changes everything. Before you ever put $1 to work, you have to know, are you an investor or are you a speculator? And trust me, this isn't just about words. It determines your entire approach. So what's the real difference? It all comes down to your mindset. An investor thinks like a business owner. They want to know, is this a good company? Is it built to last? They're focused on keeping their money safe and getting a solid, reasonable return. A speculator? They're a gambler. They don't care about the business. They're just betting on which way a little ticker symbol is going to wiggle next, hoping for a quick jackpot.
Graham himself put it perfectly. He said for something to be a real investment, it has to check 3 boxes. No exceptions. 1, you've done your homework, thorough analysis. 2, you're confident you won't lose your initial stake, safety of principle. And 3, you're aiming for a fair, adequate return. If it doesn't meet all 3 of those, it's speculation, period. And this line from Jason Zweig, who edited the modern version of Graham's book, just hits the nail on the head. Think about it. When you're investing for the long term, the profits tend to flow to you. But when you're speculating, constantly trading, chasing trends, paying fees, the only one who's guaranteed to get rich is your broker. Okay, so you've got your compass. You know you need to be an investor. Now you need a shield. And this is Graham's most famous, most important concept. It's the central pillar of his whole philosophy, and he called it the margin of safety. He had this brilliant way of explaining it. When you go to the grocery store, what do? You look for value, right? You compare prices, you check the quality, you're looking for a good deal. You're being rational. But perfume, that's all about emotion, feeling, the fancy bottle, the marketing. Graham's point is you have to bring that same bargain-hunting grocery shopper brain to Wall Street. And why is he so obsessed with getting a good deal? Because of this right here, the brutal, unforgiving math of losing money. Look at this. If you lose 50% of your money, it takes a 100% gain just to get back to where you started. That's a steep, steep hill to climb. So rule number 1 isn't get rich. It's don't get wiped out. So what exactly is this margin of safety? It's really simple. It's just the gap between what a company is truly worth, its real underlying value, and the price you actually pay for its stock. If you can buy $1 worth of a solid business for 60 cents, you've got a 40-cent margin of safety. That's your cushion. It's your buffer against bad luck, mistakes, and all the crazy swings of the market. Now, this next part is my absolute favorite.
It's Graham's masterpiece of storytelling. To help us deal with the pure emotional craziness of the market, he invented a character, a parable, that makes everything clear. Let's meet our new business partner. His name is Mr. Market.
So, here's the story. Imagine you own a small piece of a good business, and you have this partner, Mr. Market, and he is, let's just say, a very emotional guy.
Every single day, he shows up and screams a price at you. He taps you on the shoulder and says, "Hey, want to sell me your shares for this much?" Or, "Hey, want to buy my shares for this much?" Every single day. He never stops.
And here's the secret to understanding him. He is a total manic depressive. Some days he's euphoric, on top of the world. He thinks your business is the greatest thing ever and will offer you a ridiculous price for your shares. Other days he is a nervous wreck, totally panicked, and will offer to sell you his shares for practically nothing just to get out.
And the whole point is this: Mr. Market is there to serve you, not to guide you. You are never forced to trade with him. You can just ignore his silly offers day after day. Or you can use his moods. You can buy from him when he's freaking out and selling cheap, and maybe you sell to him when he's deliriously optimistic. The beautiful thing is, you are in charge. He is not your master.
So let's put it all together. We have our compass, the investor mindset. We have our shield, the margin of safety. We have our secret for dealing with market madness, Mr. Market. Now, Graham lays out a clear, simple path, especially for what he calls the defensive investor. That's basically anyone who wants safety, peace of mind, and solid returns without a ton of stress.
And his core recommendation is so simple, it's almost shocking. A permanent 50-50 split. Half your money in a diversified portfolio of stocks, half in high-quality bonds. That's it. The stocks give you a share in long-term growth, and the bonds? They're your anchor, your shock absorber. They keep the whole ship steady when the stock market gets stormy.
And how do you actually do this? With a brilliant, almost automatic technique called dollar cost averaging. You just invest the same fixed amount of money on a regular schedule, say every month. When the market is down and prices are low, your money automatically buys more shares. When the market is up and prices are high, it buys fewer shares. It forces you to be disciplined and takes all the emotion and guesswork out of it.
Which brings us to the final and most profound lesson from this whole book. After all of this incredible wisdom about analysis and value, Graham says that your success in the market doesn't actually come down to your brain power. The most important question isn't how smart am I, but do I have the temperament to be an intelligent investor? In the end, it's not about your IQ, it's about your character. Can you control your emotions? Can you be patient when everyone else is greedy? Can you be brave when everyone else is fearful? Can you think for yourself? That is the real challenge and the real key to success. And that is a question that only you can answer.